This CKNW podcast is brought to you by Destination Toyota in Burnaby, your neighborhood Toyota store.
Today we got the legend Jim Dines is going to be with me coming up at the top of the hour. I'm really looking forward to that. In just a couple of minutes, I'm going to have Ozzie Jurek online with me. He's going to talk to me about, hey, North America's number one resort is going to be back. And it's hit bottom. We'll tell you more details in just a moment. Michael Levy on the wild world of gold, Victor Adair on what he's trading. In these markets. I've got a bit of a cold. You'll have to forgive me. And coming up, a couple of goofies. We had the goofy all set to go. Then I had a late entrant yesterday. I'm throwing that one in too. We've got a shocking stat of the week. So no shortage of things coming your way. First off, it's amazing, but the very factors that are currently having the biggest impact on our financial lives seems to be of little interest to most people. I mean, as I say, very, very surprising when you look at it. That's why to begin the show, I hesitate to talk about central banks. I mean, most people are going to yawn at the thought. They didn't wake up this morning saying, hey, let's talk central banks. But most notably, the Federal Reserve are the main force in setting your mortgage rate, in determining what you'll earn in your bank account and what the Canadian dollar buys in the U.S. or Europe, and what your RRSP and pensions are worth. I mean, come on, this is big-time stuff. I think that's my little way of saying you should care about this. But what most people don't seem to understand is that with the exception, and Canada be in this, and Germany, Australia, and a couple of other countries, unelected central bankers throughout the world are forced to act because of a political class that is failing. Well, has failed when you look at so many areas like all of Southern Europe or cities like Detroit in the U.S. I mean, it's a phenomenal failure. But it's a political class that shows no understanding of what's going on and is devoid of leadership. I mean, politicians in Europe, the U.S., and every province in Canada, some more, like Quebec and Ontario, have enacted policies that actually hurt the economic recovery. But here's the thing. This week there's a lot of coverage in the financial press on the Federal Reserve's decision to stay the course on its easy money policies, low interest rates, and this quantitative easing. Which that means, by the way, that the Federal Reserve is continuing to create, are you ready? $118 million per hour. Per hour, $118 million in new money. And they turn around and then they buy government treasury bills and mortgage securities. I mean, this is an unprecedented experiment in money creation, and it's going to have historic consequences. Maybe it'll be the lack of confidence in paper currencies, or our purchasing power is going to go down the drain. Loss of confidence in the bond market, which would spur on inflation. I mean, there are lots of opinions. But after this week's about-face in rejecting a reduction in that quantitative easing program, I mean, the markets were prepared for 10 to 15 billion monthly reduction. Instead of 85 billion, maybe go to 70, 75. But now, without them doing it, my bet is that the consequences are going to be profound. I mean, the markets reacted strongly to the upside on Wednesday. Gold loved it, by the way. Then Friday did an about-face. I think this is one aspect that's continued to be guaranteed, and that is volatility. I've said for 4 years that stock declines were a buying opportunity to buy quality growth and yield. Well, I didn't see anything this week that the Federal Reserve did to discourage my view. I mean, their statement hints that the growth we've witnessed so far in the States has more to do with emergency easy money policies than with any kind of self-sustaining natural inherent growth in the economy. I think that's one of their big messages. I think they're also scared to death by the reaction of the market earlier in May and in June when they started to hint about tapering. I think that scared the heck out of them. But I want to let you know about 3 things that I think you should know in the aftermath of the Fed's decision to continue all of their easy money policies. Number 1, if you own stocks or mutual funds, maybe inside your RSP, of course we all do in the Canada Pension Plan, we should be very clear that the correlation between the Fed expanding its ownership of bonds and mortgage securities is huge. The more they own, the higher stocks go. That's been the historical norm. So we'll see if that trend holds, but it is clear that every whim now of the Federal Reserve will bring about a market reaction. I think that was enhanced this week. Yesterday, for example, 2 Fed governors said tapering could still happen sooner rather than later. And presto, the markets reacted negatively for that and other reasons. But it's all about the Federal Reserve now. Number two, and I think this is very important, their action this week, I think, makes it harder to unwind their easy money policies without a significant downturn in every asset class that's been bid up. I mean, it was always going to be difficult to stop this sort of juicing of the market with easy money, as we saw, in May and June when they reacted to just the mention of it. But now I think it is going to be even more violent when they do it. There is only one hope to prevent a violent down move, and that is if there's strong enough economic growth to justify the higher prices we've seen in the asset classes. But so far, come on, that growth has been elusive. I mean, the Fed just, again, downward estimates came. They just made them in June, for goodness sakes, but once again, they didn't make their estimates. I mean, it was always going to be difficult to stop the quantitative easing, as the markets told us. But, man, as I say, more violent, and look out. Only one hope, and that's economic growth that's not been forthcoming, especially given President Obama's well-demonstrated ineptness when it comes to economic and fiscal policy. And number three, the most dangerous scenario, but I think it's still about 2.5 years out, at a minimum, by the way, is that investors start losing confidence in U.S. government finances, at which point the Fed will be powerless to prevent longer-term rates from rising. Then look out. See, I still think longer-term stocks are going higher, far higher actually, as a result of the demise of the welfare state. What that's going to do is confidence will flow out of government due to the horrendous government finances. People will take their money, as they have in Greece and Spain, in Portugal, soon to be in France. They take their money out of the government finances, out of government bonds, and they find a new home for it. Well, that's the phenomena that's kept the market up at record highs. I just see that as becoming a far more it's far more exacerbated, a far more intense trend. So I do see longer-term stocks, but now I do think along the way we'll get some nasty downturns. I'm going to take a break. I'm going to come back. I've got Ozzie Jurek on the line. I got Michael Levy. We're going to talk, North America's number one resort market. Has it hit bottom? It looks like it. Also coming up, as I say, Michael Levy talking about this incredibly wild week in gold. Jim Dines, turn up the radio. It's always interesting with Jim. A couple of goofy awards. Shocking stat of the week, Victor Adair, all of that coming your way. Just settle back and enjoy Money Talks across the Chorus Radio Network.
I'm glad you're with us. Jim Dines coming up in just a few moments. Michael Levy going to talk about, gold made its biggest move since January of 2009 on Wednesday, then even topped that Thursday, but gave a lot back. I'll get to the bottom of that coming up. So much coming your way today. A great show planned. Ozzie Jurek's going to kick us off here, though, with Ozzie. I just wanted to tell you, I was sort of noticing, and you talked a little bit about it last week at your conference, that Whistler may have finally bottomed after, 5 years?
Yeah, we talked the other week about how other ski resorts, what great deals there were, and that the bottom seems to be emerging everywhere. Well, Whistler is also now looks more steady. Mike Wintermuth, who's been speaking at our events for the last 5 years, every year he came and reported sort of with a glum face that, prices are down, it's still gone down more. And in fact, we've gone down as much as 50% on some asset classes at Whistler, and 25% across the board. Well, now he feels strongly that he's seen some multiple offers, and while there's still some deals out there, he feels that Whistler is definitely at the bottom right now.
Well, interesting. You just said, on average, the prices have fallen 15%, but a good shopper might find something down 50% from 2006.
Yeah, and it's the different classes. Like a phase 2 condominium. If you bought sort of 2 suites side by side and one use was phase 1, like unlimited personal use, that's gone up 2.5 times. But the phase 2 is still the same price it was in 1998. And all other classes, quarter share, timeshare, and the hotel condos, my gosh, 50, 60% down in value. So it's been quite a ride for some owners. But from the buyer's point of view, this may very well be the year where you get that fine condo at the best resort in the world.
It's funny, I'm smiling because, of course, when the Olympics were in Vancouver 2010, one of the big predictions of the oversimple was that, of course, the Olympics would goose all those prices. And I remember doing a couple things on the radio and getting some critique. Just it was so absurd to think that single variable was going to do it. It clearly hasn't.
Yeah, no, absolutely. And we actually had done a research on Calgary and Salt Lake City and Greece and all the Olympics. And on the announcement that it was possible to have the Olympics, prices went up, and then they went down. And we thought it would benefit Vancouver and infrastructure and highways, but certainly Whistler not by itself. But the thing about Whistler is it is such a unique resort. I mean, everybody should take the gondola from peak to peak, you know. Now, we might be clinging to our seats, particularly when you have the glass bottom. And I've seen actually people clinging to their seats and moaning softly, you know, ooh, this is high up, you know. But there's very few resorts in the world that offer the kind of skiing that Whistler does. It just sort of priced itself out and went after the international market, and then the locals said, okay, I'm going to try Sun Peaks or Great Mountains in Kelowna and so on. And Whistler lost for it, but maybe it's on its way back.
Well, let me have some hot properties.
Well, at Whistler, the cheapest strata condos start at $99,000, one bedrooms at $220,000. But if you go further afield, 3-bedroom, 2-bathroom, 4-plex in Kitimat for $99,900, or 4-bedroom house in Prince George for $99,900, 3-bedroom house in Trail for $84,900. There's still some great deals, both for the investor and the homeowner in real estate in BC.
Great stuff, Ozzie. Thanks for taking the time. I bet you're happy you're not working this weekend.
Yes, I am out on the golf course.
Oh, my gosh. Well, I'm not happy about that. You're happy you're not working. On behalf of golfers everywhere, look out. Ozzie Jurek, you can find him, JUROCK.com, Jurek.com. I'll take a break. I'll come back. There was tons of action in the world of gold. I'll chat with Michael Levy about it in just a couple of minutes' time. Stay with us. Nowhere did the action of the Federal Reserve seem to have a bigger impact than in the gold market. Gold was certainly trending lower, got just below 1,300 on Wednesday morning, I guess it was, and then the Fed surprises the market and presto, scared the heck out of people who had shorted gold, and we had a big move up both Wednesday and Thursday, and then Friday gave it back. Michael Levy joins me now. We'll try and make a little sense of this. Michael, as I say, you probably need a neck brace after watching what the heck was happening. How significant do you think gold's reaction was to the Fed?
Well, you know, Mike, I think it was very significant, but it lays out a scenario just to paint you a quick picture. I think most of the market was short gold, and for good reason. It was having trouble clinging on to 1,300. The consensus was that gold was going to go lower, test out the 1,280, and maybe even head lower than that. So to have this announcement on Wednesday morning at 11 o'clock, and I'm not kidding, 1 minute after 11, gold was up $27 an ounce. In other words, it wasn't the new buyers coming in, I've got to own gold, they're not going to taper. It was a massive short covering. Those people who were short the market, who thought gold was going down, had to start to cover, and they had to start to buy. And when they do that, they scramble over each other. Just watch out, because they want to get out of that position. And by trying to get out of that position and buying gold, whether contracts or physical or whatever which way they bought it, it sent gold up like it was shot out of a cannon, Mike.
Yeah, and it's amazing from, as you say, tickling under that 1,300 mark. It got, to 1,373, 74 on that. I mean, that was a huge move in a very short period of time, which is, again, the Feds have made it so difficult in the market because it was 100% in reaction to that move by the Fed in terms of, you say, Mike, people saying, gee, I was short gold in order to cover that position. I got to be a buyer. But I guess the key is we step back now. Was the move significant in terms of taking out any important resistance?
Not at all, Mike.
Breaking to an upward level. Yeah.
No, the resistance on an upward level would have been up around 1380 to 1390. In other words, that was the area that gold had to go through to prove that it wasn't just another huge swing in a trading range, but in order to gain upward momentum. And a lot of the market analysts and forecasters, letter writers, and the like thought that we were on our way again, and that we had held around 1,300, and away we go to 1380 or 1390. Well, as you chronicled, it hit about 1372 as a high, 1373, and then come Friday morning, it gave it back. It was almost mirroring a stock market which went up on Wednesday after the announcement, went sideways till a bit higher, a bit lower on Thursday, and then gave it up on Friday. And I think the realization has come that it was strictly a reactionary move, but certainly is not going to change the trend in these markets, Mike.
Yeah, it is unbelievable here. By the way, I tried to phone Ben Bernanke. He didn't return my calls. I want to know what's next from those guys. I mean, given how influential they are. One of the things, just so people understand, is what you're just saying, Mike, is I guess for most technical analysts, they'll look at the highest point it got on Thursday as a very significant point. So as you say, 1373, whatever it was, 1373, they need to see it get above that before they think anything of any more significance. Otherwise, that just becomes the new ceiling, and I guess we could go down and test where we just were.
And Mike, I really do think now that's going to happen, because I think a lot of confidence has been pulled out when we see a $40 decline on Friday, like giving most of it back. And that's got to take the confidence out of the gold market. In other words, I don't want to be long gold. It is so vulnerable to every action and reaction in the markets. And, I also look at what Bernanke said. Then you go back in retrospect and you say, he gave some hints about that when he talked just 3 weeks ago about the employment, or the 2 weeks ago about the employment numbers not being what they wanted. So in May, we were talking about tapering, but as late as September, he really did give a clue that these employment numbers were not good, and we knew that. We talked about that. So to me, I'm a little bit of a scared investor, and that's across the spectrum, not only gold, which I watch, but also the stock markets. The Canadian dollar gave up almost a cent from its high. I don't think that the Canadian dollar is as vulnerable, but right now, boy, I'm in a real stand-aside mode.
Well, you'll be interested to hear what Jim Dines has to say coming up in a couple of minutes, because I'll ask him, with 50 years in the market, what he thinks is going to come down here. But you're quite right, Mike. I mean, just very quickly to leave on the Canadian dollar, you did see that move to 98 and basically gave back a cent. As everything that had moved up, though, aggressively on Wednesday, maybe a little bit Thursday, gave back a lot of those moves. And we did form some reversals in the market.
We sure did, Mike. And the Canadian dollar, again, it was up over 98 cents on Thursday morning. The U.S. dollar gave back. The euro was up over $1.35. And you saw the market reacting pretty well as you thought it would. Well, the Canadian dollar has given up better than a cent, but if I have any sense of confidence in any area, it would be the Canadian dollar. I feel the Canadian dollar, though doesn't have much left to the upside, certainly isn't going to give it all back either. I think Canada's got good fundamentals, and I think we've come back up. We have actually made our low in the Canadian dollar, in my mind, when we got down under 94, 93 and change, or 93.90 actually. And I really think that now we've just popped to the upside to, as you said, around 98 cents. We've pulled back somewhat, but if there's going to be a market, to me, that's going to be steady, it's going to be the Canadian dollar. But Mike, just one second back to Ben Bernanke. I just feel, as you said in your opening, that this market is really suspect, and it is really addicted to what the U.S. Fed and the amount of liquidity they're putting into that system. It's like a drug addict, and it's going to be an awful tough go to get rid of that addiction.
Thanks, Michael. We'll talk more about it next week, as there's going to be more action in the markets. Coming up, as I say, I'm talking to Jim Dines. Hey, just a quick reminder, Michael just talked about currencies. And, man, is there ever action and opportunity in currencies. Well, mark this date down, because in Calgary, October 27th, we are going to be there with Jack Crooks and a whole raft of other people, and we're going to tell you how to trade currencies and that kind of stuff. So just mark it down. I'll give you more details coming up, but I'm waiting for Jim Dines. Looking forward to it, so stay with us here on Money Talks.